Hello, and welcome to AI Market News by LM. Today, we're diving into two huge stories that are really shaking things up. First, a wild rebound in US stocks after a big tech dip, and second, the ongoing mystery of the Japanese yen's weakness. Let's get into it.
Talk about a turnaround. Seriously, what a difference a day makes. Just yesterday, the markets were on edge after a sharp AI-fueled tech sell-off. But then, boom, we saw this massive V-shaped recovery. The dip buyers, the investors who love a good bargain, just came flooding back in, flipping yesterday's fear right back into greed. It looks like, because there wasn't a big, scary fundamental reason for the drop, it was just a perfect setup for a technical bounce back. And this comeback wasn't just a one-trick pony. The rally was felt pretty much everywhere. We saw solid gains across all the major US indices. The S&P 500, the tech-heavy NASDAQ, and the Dow all finished the day deep in the green. It's a pretty clear signal that a risk-on feeling is back on Wall Street, at least for now.
Okay, so we've seen what happened. Now let's get into the why. To really get what's going on with this whiplash-inducing reversal, we need to pop the hood and look at what's driving investor psychology right now.
It really makes us wonder, right? What in the world can make the market's collective mood just flip on a dime like that? Well, it turns out it's a pretty complex cocktail of hard data, market momentum, and let's be honest, a good dose of pure human emotion.
Well, one of the best tools we have for this is the Fear and Greed Index. I like to think of it as the market's own mood ring. It looks at 7 different key indicators and boils them all down to one simple reading. Is fear or greed calling the shots right now? It's a great way to see if emotions are maybe getting the better of the market.
And if we break it down, the signs are all pointing towards more confidence. First up, market momentum. The S&P 500 is trading above its 125-day average, which is a classic bullish signal. Then there's stock price strength. We're seeing more stocks hitting fresh 52-week highs than lows. And maybe most importantly, market volatility. The VIX, which folks call the fear gauge, has calmed down quite a bit. All the pieces are lining up to support the buying spree we've been seeing.
All right, let's switch gears. While the US market is having its comeback moment, there's a whole other drama playing out in the global currency world, and it is all about the Japanese yen's persistent slide. This one number really tells the story, 154. That's roughly how many Japanese yen it takes to get just $1 US right now, which shows you just how much pressure the yen is under. And what's really strange is that even when stocks dipped recently, a time when the yen usually acts as a safe haven, it got almost no love from investors.
This whole situation is getting so pronounced that it's catching the attention of some very important people. Japan's top currency official actually came out and said that the yen's recent behavior isn't really matching up with what the fundamentals, like interest rates, would suggest. And listen, when top officials start calling market moves unusual, that's our cue to pay very close attention.
And this right here is the heart of the matter. It's all about policy divergence. It's like two central banks are on two different highways going in opposite directions. On one side, we have the US Federal Reserve, which is getting ready to start cutting interest rates. And on the other, the Bank of Japan has started to tighten, but they are moving at a snail's pace. This huge gap just makes holding US dollars a whole lot more attractive than holding yen.
But wait, it's not all sunshine and rallies. Despite all the optimism from the dip buyers, we have to talk about some pretty big storm clouds gathering on the horizon that could cause some real trouble.
Yep, there are two major stories here in the US that are casting a long shadow. We're looking at the Supreme Court's review of past tariffs and the persistent, nagging issue of the US government shutdown. Both of these are creating a lot of uncertainty.
The stakes on the tariff front are absolutely massive. We're talking about more than $100 billion in potential refunds hanging in the balance with this Supreme Court case. This whole situation is a big reminder of how trade policy can really throw a wrench in the works for the economy.
And then there's the shutdown. Day 36. Let that sink in for a moment. That is now officially the longest government shutdown in all of American history. And the longer it goes on, the more the economic consequences start to pile up.
This isn't just some abstract political fight, either. It has very real impacts. The FAA is warning that we could see air traffic slow down by 10% at major airports. It's a drag on overall economic growth. And for us market watchers, it's a huge headache because crucial economic data releases are getting delayed. It's kind of like trying to fly a plane with no instruments.
So, where does all this leave us? We've got this fascinating tug of war between resilient investors and these really big, looming risks. Let's take a look at what we should be watching in the immediate future.
If we pull up the economic calendar, and by the way, a great resource for this is a site like investing.com, we've got a few key releases on the docket for today. We're getting initial jobless claims, which gives us a pulse on the labor market. Plus, we've got data on non-farm productivity and unit labor costs, which are both super important for figuring out where inflation might be heading.
And that really is the million-dollar question, isn't it? We have a market that seems incredibly eager to buy any dip, showing amazing resilience. But at the exact same time, we have these massive, unresolved macro risks just hanging over everything. So, will the optimism win out? We'll have to wait and see.
Now for a quick disclaimer. This video is automatically generated by NotebookLM, an AI-powered tool.
The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. And please remember, this video does not provide investment or trading advice. Please make all investment decisions at your own discretion.
Thanks so much for watching. Don't forget to like and subscribe for more updates.